Joining us now, John Lonski, Moody's Managing Director, and Jim Rickards, Chief Global Strategist for, how do I pronounce this?
Meraglim.
Meraglim. All right, Jim, John, thank you guys both. I'll ask you first, John, 25K this year?
I think it's within reach. It's less than 1% away. It can be done, but if it's not done this year, it's going to be done next.
I mean, there would be no obvious catalyst, though, right? This week is sort of a thin week.
Yeah, very thin, quiet trading.
Right. But next year, you're pretty certain, January, you're pretty certain 25K.
You know, I think for the year, we should be up 7%, maybe finishing the year 26,500.
Jim, what do you think?
Well, yeah, 25,000. The thing is that what's interesting, Charles, is these 1,000-point markers, you know, they get the hats out and all that, but they're less, as a percentage move, they get less and less. This is just a couple percentage points at this point. Stock market is probably going to be down by the end of 2018. We're probably heading into a slowdown or a recession, partly because of China, partly because of Fed tightening. They're also underestimating this balance sheet normalization. That's a big tightening factor.
When you say they're underestimating it, underestimating the impact to the economy or underestimating the fact they only have to hike 3 times?
Underestimating the impact of the economy. This has never been done before. This is a completely unprecedented experiment. They've never had to normalize the balance sheet. Some estimates are this is the equivalent of 4 25 basis point rate hikes. It's a little speculative, but if you do that plus 3 real ones, that's almost a 2%. That's a huge increase in rates.
John, what do you think? I mean, we hadn't heard about the Fed in a while. Now, we were warned that when they announced the end of QE, the market was going to crash, and it really didn't. We were warned that when they actually started to roll back quantitative easing, the market would crash, and it didn't. And we were warned when they hiked rates. Of course, the first time they hiked rates, I think, was bad timing on Yellen's part. But since then, there have been a few rate hikes, and it hasn't stopped the rally.
And I think Jerome Powell has been warned by Donald Trump to go ahead and keep a close eye on the economy and the financial markets as far as the speed with which the Fed proceeds with normalization.
But to Jim's point, we've never been here before, so it's a hard roadmap if it never existed. Everything they do is trial and error.
Yeah, it's an uncertainty, but the Fed still has it within its power not to be too aggressive with downsizing its balance sheet, not to do anything foolish. There is no pressing problem with price inflation that compels the Fed to tighten aggressively at this point in time.
All right, guys, let me shift gears because Bitcoin is all the rage, and now Warren Buffett's right-hand man, Charlie Munger, says you should avoid it, quote, like the plague. Jim, do you agree with that?
Yeah, look, I think Bitcoin's on its way back to 20,000 because the manipulation, the miners and the whales. The whales are the 1,000 or so people who own 40% of all the Bitcoin. The miners and the whales are in a position to manipulate the market through wash sales. So they got to get new suckers into the game. It's definitely a Ponzi or a fraud, depending on how you want to describe it. So get it back up to 20, get new suckers in the game, and then what they do, they short futures, and then they dump the Bitcoin on the exchanges, tank the price. But whatever they lose here, they make up on the futures.
So Wall Street's involvement with the CME and the Chicago board, that's actually going to make it. That's making it more of a risk.
Correct. When the CME and CBOE announced the futures, all the Bitcoin groupies were like, "Yeah, this proves we're respectable." I said, "No, be careful what you wish for, because now you're going to get the hedge funds, the sharp traders, people know how to make two-way."
And Goldman setting up a trading desk that doesn't help the little guy.
Probably an indicator of a top.
On that same note, though, John, listen, the greater fool theory is always applied to everything, right? Whether it's stocks, gold, no matter what, there's always the notion that someone's going to be left holding the bag.
Yeah, if you want to get into Bitcoin, realize that it's really not an investment. It's a form of speculation. What you're betting on is that somebody is willing to pay a higher price for Bitcoin after you purchase it. That's not always going to be the case. And when it's not the case, you could be facing sudden losses as deep as 25%, 50%.
But, gentlemen, what about the notion, not new people who are hearing about Bitcoin on the job and now calling me up, like I've got cousins I haven't heard from in 10 years since the real estate boom, right? So, you only hear from them whenever there's a periodic boom in something. But the folks who believe in it, they say, hey, fiat currencies are worthless, right? We're talking about the Fed right now on the unprecedented action that they had to take. So that's manipulation. Fiat currencies are manipulated. They don't like the idea of major governments and being able to be involved. This takes out the middleman. They're true believers in Bitcoin beyond this period of hype right now.
Well, very few people have criticized the Fed and fiat currencies more than I have over the last 10 years. I've written 4 books on it. But the fact is, all currencies, Bitcoin, yuan, euro, Bitcoin, dollars, whatever, they're all based on confidence. Confidence is very fragile, it's easily lost and hard to regain. And I agree with John's analysis. Once this thing breaks, the confidence will be gone forever in Bitcoin.
All right, guys.